guys, and welcome to the Money Podcast. You know, with inflation on the rise and consumers on the ropes, everyone's talking about the big, scary R word, recession. Are we staring down at another recession, and what can you do about it if we are? In today's episode, we're going to talk about the signs of recession that could be on the way, plus try to figure out if we are about to enter one, and then, if we are, how to shore up your finances to help you ride things out when the economy gets bumpy. I'm Stacy Johnson. As usual, my co-host will be financial journalist Miranda Marquit. Hello, Miranda.
Hello, Stacy.
Listening in and sometimes contributing is our producer and novice investor, Aaron Freeman. What's happening, Aaron?
Hey, man. I'm feeling a little recessed.
Cool. Today's special guest is investment analyst Joseph Hogue. He's a CFA, founder of the investing website mystockmarketbasics.com. Did I say your last name right, Joseph? I forgot to ask you.
Perfect. Thanks, Stacy. I appreciate it.
Okay, let's get the ball rolling. But first, a quick disclaimer. Should we discuss specific investments in this show, don't take them as recommendations. You know why? Because they're not recommendations. Before you invest in anything, you've got to do your own research. You've got to make your own decisions. Okay, let's get back to the topic at hand. We have not discussed this beforehand. I'm hoping we're going to have a lively discussion. I say a recession is more likely than not. Let's go around the horn. Miranda, what do you say?
I've been saying that we're ripe for a recession since 2017, and it hasn't happened yet. So, I mean, sure, yes, we should be having a recession any minute now. Just waiting.
Actually, I'm glad you said that. Let's back up a step. Recession in 2022. Yes or no? I say kind of yes. If I have to bet, I'm gonna bet yes. Okay, now what do you say, Miranda? 2022 recession, yes or no?
I mean, I've been saying yes for the past 5 years, so sure.
Okay.
Might as well keep being wrong.
Okay, so yes. Okay, Joseph, our expert.
2022, no, I would say no, except for investors, it may feel like one. Obviously, if we're saying 2022 recession, will the government eventually call a recession that started in 2022? No, I think they'll call it in 2023. But of course, stocks are going to do what they're going to do before or after that.
Yeah. So you say yes to recession, but probably 2023 and not 2022.
I would say 2023.
Okay, Aaron, round us out. What do you think?
I'm going to agree with that. Most recessions seem to have low GDP and low unemployment rate and all that kind of stuff. All these little weird other things going on there, and that's not really happening all that much. Today's kind of weird, so it might be long after.
Okay, now that we've established, so basically all four of us think there's going to be a recession. Miranda thinks there's going to be one last year, and the year before, and the year before.
We're due for a real stock market crash and a real recession, and we haven't had either of those.
Oh, and you know what I neglected to do at the outset. So let me backtrack a minute here and introduce our guests a little more. Joseph, would you tell us a little bit about yourself? Because you're going to be giving us your opinions. So let's let our listeners know why they should listen to those opinions. Tell us a little bit about yourself.
Sure. Well, from Des Moines, Iowa, actually served in the Marine Corps. After that, I got into equity analysis. So I was about 10 years in equity analysis with venture capital as well as private wealth management. Since 2014, I've been managing my own blogs, and since 2017, started the YouTube channel Let's Talk Money. So really bringing what I learned through venture capital investments, through equity analysis, to regular Main Street investors. And really, loving the face-to-face interaction and the relationship I get with them as opposed to, the $1 million clients, which is all I ever saw in the venture capital.
So you are an investor in individual stocks. Is that true?
Yes,
cool.
I am.
Thank you. Thanks for coming to the podcast because
Sure.
Miranda, my co-host, just buys index funds, and it's like watching paint dry. I'm like, so what do you think of markets? She goes, what do I care? Think about markets. Let's put some more money in index funds. I'm glad to have somebody.
Well, what's the old quote? Investing should be like watching the grass grow. If you want excitement, take it to Vegas.
That may be a great philosophy for investing, but it sucks for doing a podcast stuff. We don't want to watch grass grow in a podcast. We need to have some kind of controversy or some kind of discussion. Okay, so now,
go ahead. I would add to your question though. When is a recession coming? If there is one thing, and probably only one thing that I have learned in 20 years of investing myself, 10 years as an equity analyst, is that recessions, stock market crashes, they're kind of like that proverbial pot of water, right? They're never going to boil when you watch them.
Yeah.
So it's one of those things like if everybody's calling for a recession, if everybody thinks stocks are going to crash, probably not going to happen. It's always when you least expect it, right?
And
so
go ahead,
so I guess we'll never have a recession. Never going to happen.
not unless you stop expecting it.
I'll stop expecting it. It's just not
you know
gonna
what, you
happen.
guys, we should have done too is define what a recession is. Anyone who would make an attempt at that? What exactly is a recession for our novice listeners who don't know what a recession even is? Anyone want to define it for me?
Oh, well, technically, it's the 2 quarters, so 6 months in a row of negative GDP growth, falling economic growth, right? And of course, all the things you get with that, usually higher unemployment and maybe lower wage growth.
Okay, go ahead, Miranda.
I was just going to say, I think that makes a lot of sense, though, when, Joseph said something earlier. What he said was, I don't think the government's going to call it till 2023. And so that means we might enter a recession toward the end of 2022, but we're not going to know it's a recession, and we're not going to be told it's a recession until we got to be 6 months down the road. It's one of those things. Calling it a recession is a trailing indicator, I guess.
Well, it is a trailing indicator because you're talking about the last 3 months of GDP growth or negative growth. So it's by definition a trailing indicator. Now, how long does a typical recession last? Anybody want to take a stab at that? 17 months is the typical. But actually, by the way, though,
I have to look that
by
up.
the way, if you do look that up, you'll find a whole bunch of different definitions. You'll find some that say 28 months. I said 17 months because that's when I saw the most, but I saw all different kinds of guesses. I mean, I saw, authoritative sources using different numbers and radically different numbers. So, but we can call it a year and a half or so is a typical recession, but they don't always last that long. They could be short and steep. They could be long and horrible. There could be any number of things. So let me go back to Joseph. Joseph, let's say we're going to have a recession. How bad is it going to be? Should you sell everything? Should you be out of the market?
Sure. Well, and going back to your disclaimer about financial advice, right? The hardest part here is that we're talking to so many different investors with so many different needs and goals. And the biggest question every investor needs to ask themselves is, how long until you need the money, right? If you do not need that money in your investments for 10 plus years, then no, I would say just keep on what you're doing. Keep on investing every single month. Invest in the stocks and the companies that you love, and because if there's one thing that the stock market will always do, it will always go up eventually, right? So it is going to build up to higher prices. If on the other hand you've got less than maybe 5 years until retirement, until needing that money, then that's when this becomes very much a more important question for you, because if stock prices do fall another 15 or 20%. Then it might take them quite a bit longer to get back up to the point where you need it. Remember, it took the NASDAQ 14 years after the bubble crash, the internet bubble crash in 2000, to build back up to that point, right? So if you were saw your portfolio fall there or in that 2008 crash, then it could have been quite a few years, 3 to 5 years before you were able to get back to that point.
Let me ask all you guys this. Since everybody has the opinion that ultimately there's going to be a recession, what's your evidence for that? Why do you think that that's going to be the case? What are you reading? Do you have headlines? Do you have thoughts? I mean, what exactly makes you think there's going to be a recession? And also, as a follow-up question, what the hell's so funny about a recession, Miranda? Because you keep laughing.
Well, it's funny because, like I said, I've been saying we've been due for one for since 2017. So that's why I'm laughing. It's not necessarily that I think a recession's funny. I just think that, I just keep expecting it to happen and it just doesn't. All
right. So we're setting Miranda up to be the villain here. I like this.
Yes.
Yeah,
that's what we do every week.
That's what we do.
As a matter of fact, Joseph. So.
But no, I mean.
Anyway, so why is everyone so convinced?
So I think part of it is that in general, markets and economies are cyclical to some degree. And so what you can expect is some sort of down cycle every 8 to 10 years, every 7 to 9, 8 to 10, somewhere in there. You can expect some sort of a down cycle. You can expect some sort of pullback. And so for me, it's just mostly looking at the cycles and saying, okay, well, 2017, 2018, we were kind of due for one. They kind of staved that off a little bit with the Tax Cut and Jobs Act and all of these companies getting a bunch of extra revenue and buying their own stocks back and being able to prop up the market. So then I was like, okay, so we put it off a little bit with policy, with laws, but then the pandemic came and, people were having some struggles and everything else. And so it's like, okay, that's something that's probably likely to trigger recession. But then,
Well, that was a recession, right? 2020. I mean, by any definition.
We actually didn't. No, we actually didn't. I don't believe we did. Did we actually move into a recession?
Because we didn't have 2 consecutive quarters. Is that why?
I think it was technically a recession. Maybe.
Well, I mean, it certainly was a bear market. So we know that.
Sure.
Yeah,
we got a very short. We got a very short kind of flash crash that recovered within weeks and months of the stock market.
Yeah, that's true. The stock market.
The stock market recovered almost immediately after crashing. So just kind of just looking at it cyclically.
But unemployment went to 10%.
Right.
Whether it was 2 quarters or not, it was a really bad time in the American economy.
It was not great, and we didn't feel it, and so that's why I was kind of surprised that it didn't last longer. Right? We kind of pushed off. Yeah. So but part of what we've been doing since the 1980s is constantly trying to push off these cycles. Nobody wants to be president. Nobody wants to be in charge of Congress when we have a regular old down cycle. Nobody wants to be in charge. And so we just keep trying to push it off, which is why I'm actually waiting for something bigger, because the longer you put these kinds of natural cycles off and these natural pressures off, like I just feel like there's got to be something bigger coming. Because of how long we've put it off. There's only so much quantitative easing we could do. There's only so many times our companies can buy their stocks back and do this without providing any sort of relief for working people in terms of like real, results, right? I mean, companies are seeing record profits right now. And most of our inflation right now is actually coming from companies jacking up prices and blaming it on the supply chain instead of absorbing costs. And we talked about that in the past. So I just figure at some point it's inevitable at some point.
Well, that's true.
So let's have okay, now everybody tell me I'm wrong. Let's do it.
You're wrong. No, well, okay. Let me ask you this, Joseph. I was going to ask you too, why are we going into recession? But let me read you something first. Now, today is April 7th, 2022. And just this morning, it's a Thursday, and that's when they do the unemployment reports. And today, I'm looking for here we go.
166,000, right?
Yeah. U.S. jobless claims fall to 166,000, lowest level since 1968. Now, this is from the Wall Street Journal. I'm going to read you a little blurb. New applications for U.S. unemployment benefits fell last week to a near 54-year low as employers held on to workers in a tight labor market. Competition for workers has driven up wages, especially in industries facing the worst shortages, like leisure and hospitality. Average hourly earnings grew 5.6% in March from a year earlier. Okay, so this would be the exact opposite of a recession, right?
Sure.
I mean, we just had the best or the lowest jobless claim since 1968. So, yes. Okay, so help me understand this, Joseph. I'm reading that the economy's rocking.
It
and
is.
Yet we're all talking about recession. Why is that?
And I'm going to give you another statistic, and it's going to feed into exactly why we will get a recession. The other one, 8%. That's the consumer price inflation year over year as of the last month. Now, that's going to be updated here on the 12th. So in about 5 days, it's updated consumer price index comes out every month around the 12th. And that will probably be double digits. So probably 10% plus this month or this next reading for the month of March, just because of the increase in gasoline, the increase in commodity prices, things like that due to the Ukraine invasion. But it was already 8%, which is as high as it's been since 1982. So there's 40-year high in inflation. And the problem here is the Federal Reserve. And, I love the Fed. They do a lot of great things. They're smarter people than I am, but they are horrible at balancing their two mandates. They are horrible at balancing interest rates. And almost, 90% of the recessions we get are because of missteps by, the Federal Reserve. Okay, so the Fed has two mandates. It needs to keep unemployment low, but also keep inflation low, right? And those are two very contradictory forces sometimes, because if you've got a strong economy like we have now, very low unemployment, and great job growth, then you're probably going to have a little bit higher price inflation, which is exactly what we're seeing, 8% highest in 40 years. So what the Fed is doing now, after many, many years of keeping interest rates very low, basically at zero, and really juicing the economy with that low cost of borrowing money. We've seen trillions of dollars added to the balance sheets of companies just by borrowing, because it's basically free money. They are now going to be raising those interest rates. They're now going to be taking that stimulus out of the economy. And you know what? They can do it as fast as they want, because that unemployment level is so low, because jobs are so good. They can raise interest rates rapidly because they really need to handle this other side of that mandate, of the coin, the inflation. So they're going to be raising interest rates very fast, going to bring the economy to a screeching halt. And like I said, the Fed has been historically horrible at doing this, horrible at balancing that, where they don't raise rates too fast to choke off the economy. So what I think is going to happen is we get through this year. The Fed has raised rates from 0 to all the way up to about 2.5% to 3%. And at that point, you really do start to see the economy slow down. You see that cost of borrowing really start to hit companies. You see the wage growth and the inflation really start to hit their profitability, which means, of course, they have to lay off workers to maintain that profitability, and that turns the tide on employment as well. So it's really kind of the cyclical nature that Miranda was talking about. I hate to agree with her, especially since she had to point out that companies are the devils here, and the profits. As a stock investor, I have an ownership interest in those profits. So go companies. But
you'll have to forgive the communist member
do
of
they
our
need
panel.
a gouge? Do they need to gouge us?
Oh, hey.
Well, it depends on what companies they are. If I own stocks, then yes, they do.
Listen, comrade. Okay, listen, comrade. This isn't about that. Okay, we're talking about recession now. And let me just summarize, because we're going to have to go to break, and then we're going to come back and talk about exactly what to do if we are looking at a recession. But let me just summarize. Essentially, what the Fed is trying to do is they're trying to raise interest rates enough to slow the economy enough so that inflation subsides. If they're able to do that without causing too much disruption in the economy, that's called a soft landing. It's very rare, though, and it's hard to do, and especially when the Fed is as behind the curve as they are now. So the reason we all think there's going to be a recession is because inflation's high, interest rates are going to go up to combat that inflation, and those higher interest rates might slow down the economy to such an extent that it causes a recession. Everybody agree with that?
Great summary.
Okay. Now,
Well done.
so we're going to take a
Always
really
good to
quick
agree
break.
with the host.
We're going to take a really quick break, and then we're going to come back and tell you exactly what you should do. And we'll ask Comrade Miranda what she thinks you should do too to combat this potential recession. We'll be right back. Okay, we are back. So I'm interested to know now. I know what Miranda's going to do in the case of a recession. She's going to keep putting money into an S&P 500 index fund.
Dollar cost average into my index funds.
Okay, seriously, Miranda, is there something, because I know that Joseph's going to have some ideas, is there something you would advise people to do? If you know there's a recession coming, would you do everything exactly the same, or is there something you would do differently?
Yeah, so for my retirement fund, I'm going to keep it the same, keep the dollar cost averaging going. For my travel fund, mostly the same. I might tweak my asset allocation to focus more on my bonds and some of those kinds of securities. But the biggest change is going to be in my son's college fund. So I use a bucket strategy for him now that he's going to be starting school. So I sell some stuff high and say, okay, this is how much cash I need for the next couple of years for schooling, and I move that into cash and kind of shift that around a little bit so that I'm still leaving money in to grow in stocks, but also saying I'm going to need this cash. So I go ahead and sell some of that and redo my asset allocation a little bit to reflect my needs. Sort of like what Joseph was talking about earlier on. When do I need the cash? What do I need it for? And how do I position myself now before the crash comes?
So fair to say you're being a little more cautious.
Yeah.
Okay, fair enough. Okay, now, in fact, we haven't heard from Aaron in a while. Aaron, is there something you would do about an impending recession? What would you do differently? Aaron knows a lot about real estate. Knows something about stocks, not quite as much perhaps as the rest of us, but something. But anyway, so Aaron, what would you do in the face of an impending recession?
I don't know. This year is it's a little bit odd. If you go through the 70s and 80s and 90s and you look at housing, every recession, housing usually doesn't go down. It'll actually still go up. But there's a big change this time, and that is, even though it seems like there's been a lot of investing in real estate, which has really pushed it up a lot. A lot of times when the economy is kind of wishy-washy, people buy land because it's stable. So I'm not really sure. I mean, COVID kind of threw the whole thing into a different realm where people stayed together. They didn't move around. People moved back in with families. And now all of a sudden there's a big uptick in divorces. There's an uptick in all these kids leaving that house and trying to find homes. There's been lower building, so there's not, there's a little bit of shortage in house building, but yet it's still there. It's a lot of multifamilies are being built. So there could be an explosion of houses being put back on the market.
You mean like foreclosures?
No, just, people, like, there's been a lot of divorces, but now people are going to bring their families back together, so they're going to sell, this extra house.
So there's going to be a lot of inventory, which is a problem now.
There could be a lot more inventory down the road. It's going to take a while, but
so now, would you use the recession to take advantage of? Well, you said that prices weren't declining, or we didn't expect
usually they don't decline in during recessions.
But there may be fewer buyers, and maybe it'll get better deals in a recession. One would hope.
Yeah,
by definition.
If you define recession by
mortgage rates are hitting 5%,
getting higher and people are making wages and stuff like that. I mean, every recession seems to be built based on weird elements. It's not really, the Fed is just trying to control crazy things that are out of control, like, low fuel, wars, the housing bubble, the .com. It seems like all these crazy events happen that create the recession, and the Fed is playing catch up to all of these things. So when you're trying to predict it, it just seems like a very hard thing to predict, like what's going to be the next event that rolls it out. So I don't know at the end,
Yeah. Okay, Joseph, you're our expert. Tell me, okay, you've already told me you think there's going to be a recession. Now tell me what to do about it.
Sure.
I'm a huge stock investor, just like you are. So tell me what I'm supposed to do.
And, I'd agree with a lot of, I hate to say it, I'd agree again a lot with what Miranda says. In the eventuality of a recession, I mean, you want to be in those safety sectors, right? Utilities, stocks in the consumer staples sector, those companies that sell things you have to buy, things like Pop-Tarts that are going to have, those stable cash flows and typically do better than, maybe your tech stocks or other growth stocks in a recession. Even bonds. Bonds right now, bonds have been pretty much dead money for the last year or so, but bond yields are getting up. I think the Vanguard long-term bond fund, the ticker BLV, actually pays a 2.9, almost a 3% dividend yield right now, and is down something like 15% over the last 3 months, which is unheard of for a relatively safe bond fund. So eventually, you want to look for the safety in those kinds of stocks, utilities, consumer staples, some of those bond funds. More importantly, though, I think is to realize that this might be the best time to invest. Really, your opportunity to buy all the way on the way down, rather than what most investors do, right? They get excited when the market's going up. Everybody's talking about stocks, and they're buying all the way up. They're buying as those prices go up. Well, why not? Why not turn that fear on its head and start buying on the way down? So you're getting those prices all the way down. I would say, though, like we talked about with the boiling pot and how the stocks never crash while you're watching them, being, if you're going to be actively investing here and, changing up your stocks and your investments according to, what you feel is going to happen, being early is just as bad as being wrong sometimes, right? Yeah. If we do look at some of the history here, during Fed rate increase cycles, okay, so while the Fed is increasing rates, stocks typically go up. If you look at the last 3 cycles here, starting in June 99, June 2004, and December 2015. December 2015, Fed actually raised rates for 3 years. And stocks, stocks did, large cap growth stocks did 12% a year through that period. Over all 3 of those periods, Large cap stocks did about 12, 13% on average. Even bonds went up. Even bonds returned positive.
Interest rates went down during the recession, right? So that makes bond prices
Well,
go up.
no, while the Fed was increasing rates.
Oh, okay.
So during these rate hike cycles. So, counterintuitively, right? Because bond prices are supposed to go down when rates are going up. But during those periods, and you just have to look at the underlying reason. Okay, why is the Fed raising rates?
Yeah.
Because the economy is good. It feels that it can raise rates to bring inflation down a little bit. So the economy is good while the Fed is raising rates. What you need to be worried about is when the Fed starts saying, I don't know, the economy is looking a little shakier. We're going to stop, we're going to pause or slow down the rate hikes. That's usually when you get the warning signs, and that's usually when we do actually see a recession, because, of course, that's when that rate hike cycle that came before actually starts to hit the economy, as we were talking about.
Yeah, it's interesting. Oh, go ahead, Joseph. Finish your thought.
Well, I would say, again, just do not get panicked out of this market. Do not feel like you have to jump out of stocks just because you hear about an inverted yield curve or the Fed raising rates or anything like that. It is much more of a wait and see kind of game. Keep that habit of investing every month, investing your money every month. Maybe build up a little bit more cash, like I said, because there will be some eventually some great prices to go at when stocks do start coming down, and that's when you want to start buying. You don't want to get panicked. Don't want to get shaken out of this market and be afraid to get back in and start buying stocks at those prices.
Well said.
Yeah, I like what you said about the cash thing. I've actually been, my business has been doing pretty well, and I've been I'm staying the course with the dollar cost averaging in the plan, but I have been setting aside a little extra cash so that when the recession comes, when the stock market really does crash, I can pick up some bargains.
Yeah,
sure.
Well,
sure. And invest in yourself, man. Right? If stocks seem expensive, if the stock market seems uncertain to you, and you're really worried about stocks going down, then invest in yourself, invest in your own business, so you can create that cash flow to invest later.
Yeah. What I've been saying for months now, Joseph, is if you're not going to adjust your portfolio, adjust your expectations, and this is happening now. The market is down for the year. And I've not sold stocks. I was going to, because I am 5 years from retirement. And I was going to sell a bunch of stocks because I knew the market would have to top, obviously, because it went up 20% plus every year for 3 years in a row. I mean, just to return to the mean, it's going to have to go down. And this would have been a perfect opportunity for me to sell. Why did I not sell? Because I'm not smart enough to know when to buy. That requires two decisions: when to sell and then when to buy back in. And so what I did instead was I adjusted my expectations, put less money into my portfolio, as Miranda just said. So I have all my extra income that I have, it's not going into the stock market now, although I still have a lot of money in the stock market. But what's interesting about the stock market, though, and things you hear are: A, stocks are a good hedge against inflation, but B, rising interest rates because of inflation tend to hurt the stock market. Both these things are true in different ways. So what's important to learn, if you're listening to this, is that not all stocks go down in a recession. I mean, unless if there's a huge crash, basically yes, all stocks go down. But right now, if you have companies that make money and have pricing power, you can be fine. I own Apple. I own ConocoPhillips. These are companies that make money, have a product, can raise prices if they need to. And with an oil company, I mean, they're benefiting from inflation. So remember, it's a market of stocks, not a stock market. Companies that don't make money, that are real risky, they're the ones who are getting tanked right now. Companies that do make money, not so bad. So that would be the thing I would urge people to do. And you can invest in oil in a sector fund, in an ETF. You can invest in pharmaceuticals. They're not going down if there's a recession. So there are places you can hide and still make money in recessionary times. Agree, Joseph?
Oh, absolutely. And I think it's really that changing of the guard, so to speak, from what has worked so well over the last 3 years, even the last 10 years, growth historically over decades of value stocks had beaten growth. And then just over this last 10 years, growth's just taken off with those low interest rates and really fast global growth. In fact, and you get these fund managers like Cathie Wood that have just become gods in the space. And people start to question that Warren Buffett value approach to investing. And now I think as that turns back, and we start seeing these companies that are those typical value stocks, those companies of strong cash flow and stable cash flow companies that Warren Buffett loves to just buy. I think as we see those come back into favor, then people start switching back over into that. And those are going to be the stocks that are going to protect you the most. Right?
Yeah, I had to laugh when you said that, Joseph, because I just last Friday, April 4th, I bought a mutual or an ETF that goes up in value as Cathie Wood's ARK fund goes down in value.
The counter, yep.
And by the way, this is called a hedge for those of you who are unfamiliar. So I own a bunch of stocks. So what I'm doing is I'm going to benefit when some other stocks go down. I own stocks like I just described. I own Apple. I own Conoco. So I've got stocks that are making money and have pricing power. But I know that these companies that are more speculative may go down. So I bought an ETF that becomes more valuable as those speculative stocks go down. And that stock, in the last week, I've made about 60% on it. Actually, I'm sorry, that's not true. I made about 20% on it. Another thing I did too is I hedged my Apple. I don't want to sell my Apple, but I don't think it's going to go to 180. So I sold the right for somebody else to buy it from me at 180 when it was about 178 this past Monday. And now it's down to 171. So I gave somebody the right, they paid me for the right to buy my Apple between now and 2 weeks from now at 180. It's at 170. That I collected $6,000, and now I can buy that back. This is a hedge position. I can buy that back for like $1,000. So I made like $5,000, not betting that Apple would go down, but betting that it wouldn't go up past 180. So these are
that covered call strategy. It's a great strategy and great strategy for any energy stocks, oil investors, gold investors, things like that. Those commodities have just gone through the roof. But they are starting to come down. But what you got to understand with these oil stocks in particular, like Chevron, like ConocoPhillips, they are still making boatloads of money, even if oil comes down. Oil comes down from $101, $110 a barrel, now down to about $97 a barrel. Even if it comes down further, Chevron has a cost of production right around $40 a barrel, right? So that oil price is going to come down, and the stock may come down a little bit, but the company is still making a cash flow. It's a cash flow machine, right? And instead of they see the writing on the wall, they see the death of oil and some of these fossil fuels, so they're not exploring, they're not spending quite as much money for the future growth. They're sending that cash flow out to investors through a buyback, through dividends. So I want to keep those shares, but I'm a little worried. I want to hedge against that near-term stock price. So that covered call strategy, great way to keep the shares, keep that cash flow machine going through the dividends, and take a little bit of risk out of the stock.
Absolutely. Now, and these are relatively sophisticated things, hedging. So I apologize to those of you out there who are listening, because we're not going to have time really to go into it. In fact, we're about to close. But just be aware there are things you can do other than selling your stocks to either protect your profits or to hedge against a falling stock market. Although nothing is available with no risk. I mean, there are things, I could have got my Apple called away at 180. So, there are things that can happen. But just be aware there are things you can do. And the main thing to be aware of is that this is the deal, guys. This is a cyclical economy. And this stuff's going to happen every now and then. Don't look at it as one of the expressions I remember from back in my days as a stockbroker was, Wall Street's the only mall on earth where when things go on sale, nobody wants to go. So remember that what Joseph said, when prices go down, that's when you're a buyer, not when you're a seller. So anybody else have any last thoughts before we close this one out?
Just keep that habit of investing. Invest every month. Maybe you keep some of it in cash rather than actually buying stocks, but keep that money going into your account and understand again, that the best opportunities are as prices come down.
Awesome. Miranda, Comrade?
Yeah, I was just going to say, don't forget too to position your other areas of your financial life. While the stock market is crashing or we're getting ready for a recession, thinking about doing things like paying down your debt, because as rates go up, as the Fed tries to keep this going, your debt's going to cost a lot more money. So if you have those credit cards, if you have those kind of variable interest rates, look at paying down some of that debt. Look at boosting your savings so that you're ready to take advantage of these stock market deals, or so that you're ready just in case, when the recession hits, if you lose your job or you have some other issue, some cash flow issues, you've got your savings boosted up, and figure out where are your priorities, what can you cut? Like, look at your budget. Now is a good time before a recession to say, here's my budget. What are the most important things? What do I have to cover? And what, if the recession comes, can I cut to improve my budget and my cash flow during these times? So get that now. Figure that out now.
Those are great suggestions, Miranda,
so
and I wish I thought of and brought them up earlier. You're absolutely right. Okay, we are out of here. We are out of time, guys. But you know what? We are never, ever, ever out of topic. Dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is Miranda Marquit, MARQUIT.com. And of course, you want to see Joseph at his website. That is mystockmarketbasics.com. mystockmarketbasics.com. If you got a question, or comment, or topic you'd like to suggest, we'd love to hear from you. Email us at hello@moneytalksnews.com. That's hello@moneytalksnews.com. And one final thing, if you appreciate what we do, then do something for us. Subscribe to our podcast. Takes you 2 seconds. Helps us, though. So if you like us, show us. And subscribe. I'm Stacy Johnson.
I'm Miranda Marquit.
I'm Aaron Freeman.
And Joseph Hogue.
Thanks for hanging out with us, guys. We're going to see you right here next time.